Being a more aggressive kind of dividend investor, I'm always on the lookout for higher yielding dividend stocks and ETFs that'll pay me a high amount in passive income while balancing the risks involved with holding these particular stocks and funds. But finding stocks that offer investors a high dividend yield while not being a dividend trap at the same time isn't always an easy thing. The general rule of investing is that stocks that offer higher dividend yields are almost always considered to be riskier investments. But if you regularly watch my channel, we know that there are good options out there for people who are looking for higher yielding stocks and ETFs that aren't terribly risky. Some stocks like REITs and business development companies are two examples of stocks that are required to pay out high amounts of dividends. But despite that, there are plenty of high yielding dividend stocks that pay high dividends but have a pretty bad track record in both their share price and their dividend distribution amounts. So when finding stocks that have high dividends, it can be tricky to avoid these kind of holdings. We want to make sure that we're looking at more than just the dividend yield, but whether the company will be able to continue to pay their dividends into the future. So in today's video, we're going to be taking a look at a few companies that currently offer dividend yields of over 8% and in my opinion, show pretty good future prospects. Many of these companies have a long history of dividend growth, or I believe they have the potential to flourish going forward. I don't have a crystal ball, so there's no way to know for sure what the future holds for these companies, so be sure to do your own research and come to your own conclusions. So with that being said, let's get into it. The first stock we're going to be taking a look at is Omega Healthcare Investors, ticker symbol OHI. Omega is a real estate investment trust that invests primarily in the long-term healthcare industry, primarily in skilled nursing and assisted living facilities. As of June of this year, Omega's portfolio consists of 954 facilities across 42 states and the United Kingdom. Currently offering a dividend yield of 8.41%, Omega's been able to provide 17 consecutive years of dividend growth according to their June investor presentation. As I'm sure a lot of us are aware, the pandemic caused a lot of issues within the assisted living industry. Many nursing homes experienced a lot of bad publicity for how quickly the virus was reportedly able to spread within these facilities. Despite all the bad media coverage, only two of Omega's operators, who only make up 3.2% of their contractual rent and mortgage payments, expressed doubt as their ability to pay rent. According to their latest investor presentation, Omega is currently exploring different options regarding this, and they say that they're confident that they'll be able to find a solution. Yet despite the pandemic, there's certainly no doubt that the need for assisted living facilities is only going to continue to increase. As time progresses, people are going to keep living longer, and as a result, more people are going to need assisted living facilities. This graph shows that the US population of those over the age of 65 is only estimated to keep growing. By the year 2040, there could be an additional 24.7 million people over the age of 65 compared to the estimated number in 2020. Omega is also a triple net lease REIT, which is another thing that I really like about them. If you're not familiar, a triple net lease REIT is a real estate investment trust that owns properties and rents them out to tenants just like any other REIT, but with a triple net lease REIT, the tenant is fully responsible for paying all of the expenses, including maintenance, insurance, and taxes. This reduces costs for Omega pretty significantly, and not all REITs out there are triple net leases. From a financial perspective, Omega has continued to grow in a positive direction in terms of their EBITDA, which is their earnings before interest, taxes, and amortization. Their income statement shows that they did suffer losses during the third quarter of 2020 because of the pandemic, but since then revenue has been picking back up again. Given the need for their facilities, as well as the expected continual need for them, I think it puts Omega in a pretty good position going into the future. Next up, we have Ares Capital Corporation, ticker symbol ARCC. Ares Capital is a business development company that specializes in the acquisition, recapitalization, and leveraged buyout transactions of middle market companies. They make investments in companies engaged in the basic and growth manufacturing, business services, consumer products, healthcare products and services, and the information technology service sectors. If you're not familiar, a BDC is a company that invests money into small and medium-sized businesses in order to help them grow or, in some rarer circumstances, rescue them from a difficult financial situation. These companies approach BDCs for money because they're usually too small to be publicly traded on stock exchanges, but they're way too big to go to a local bank and ask for a loan. So in some ways, a BDC is very similar to investing in a private equity fund, only you don't have to be an accredited investor to invest in a BDC. Ares Capital is currently the largest BDC in the United States in terms of both net assets and market capitalization. Their stock currently offers a dividend yield of 8.24% and they pay dividends quarterly. They recently just increased their dividend amount to 41 cents per share as well. When it comes to business development companies, I always like to say that there's strength in numbers. One way that's super important is by looking at a BDC's investment portfolio. According to their latest investor presentation, their average investment only makes up 0.3% of their total investment portfolio, and their largest is only 2% of their total portfolio. 77% of their investments are in senior secured loans, which are safer than subordinated debt or equity investments. They're also well diversified among a large number of different sectors, which is also really important for a well-balanced BDC. Software, healthcare services, and commercial and professional services make up the largest amount of their portfolio, but they also have investments in energy, insurance, automobile and component parts, among many others. Ares has been around since 2004, meaning they survived both the 2008 financial crisis and the pandemic. And while they did cut their dividend in the wake of the 2008 financial crisis, they were actually able to grow it during the pandemic, which is definitely not something that other BDCs or REITs were able to do. Plus, if you were to compare Ares with the S&P 500, Ares actually performed much better between March of 2004 and June of 2021 if you were to reinvest those dividends. I've said it several times on my channel, but Ares Capital is still my favorite BDC out there, and I think the numbers help support my reasoning. Now, this next stock is a little different, as I avoided this stock before the pandemic, whereas now I think there could be a really good buying opportunity. I'm talking about New Residential Investment Corporation, ticker symbol NRZ. This is a mortgage real estate investment trust that focuses on investing and managing residential mortgage-related assets in the United States. Their stock currently offers a massive dividend yield of 9.1%. As you can tell by this stock's performance, in early 2020 during the pandemic, this stock's share price plummeted pretty dramatically. It was staying pretty consistent in terms of growth, both in its share price and dividend distributions, for nearly the first 7.5 years after being publicly listed. But then the pandemic hit, and this stock's share price went all the way from $17.50 to just $3.30 a share. It was also during that time that the dividend was slashed from 50 cents a share to just 5 cents a share. But as you can see, New Residential's stock and dividends have continued to recover. Now trading at $10.84 a share, it's up quite a bit from March of 2020, and they've also been making progress in trying to restore that dividend. It's gone up from 5 cents immediately after the plunge to now 25 cents per share. Their stock is currently trading below book value, which is one of the most fundamental ways to determine if a stock is undervalued or not. Now, New Residential is a little more complicated of a company to explain because they're not like your typical mortgage REIT. For one thing, they invest a lot in something called mortgage servicing rights, or MSRs. It would take me a long time to explain exactly how these things work, but in a nutshell, an MSR is when a bank issues a mortgage, but relies on a third-party company to collect the monthly mortgage payments. The reason banks do this is because some of them issue a lot of mortgages to people, and it can become both a very time-consuming and costly thing to handle all of these loans. So some banks will basically outsource this role to a company that processes mortgage servicing rights, aka companies like New Residential. I might make a more in-depth video explaining this company, so if that's something that would interest you, feel free to leave a comment below. Additionally, New Residential is expanding even more into mortgage servicing rights, as they just recently bought Caliber Home Loans back in April of this year, who are one of the largest mortgage originator service providers. New Residential paid roughly $1.67 billion to fund this acquisition, and as a result will add 3.2 million customers in their full MSR portfolio. New Residential expects this deal to result in greater revenue, reduced fixed and variable costs, diversified sources of capital, and overall increase their product offerings. I think it's a pretty exciting time for this company, and I'm looking forward to see what the future holds for them. Before continuing, if this video provided you with any sort of benefit, please consider clicking the thumbs up button below, and also subscribing to the channel for more aggressive dividend investing strategy videos. Thank you all so much for watching this far, and for all of your continual support. This last stock is another one that I haven't talked about on this channel before, and that's Owl Rock Capital Corporation, ticker symbol ORCC. This is a relatively new BDC, as they've only been publicly listed for about 2 years. Owl Rock makes investments in senior secured or unsecured loans, subordinated loans, or mezzanine loans, and also considers equity-related securities, including warrants and preferred stocks. Despite being one of the newer BDCs out there, Owl Rock already has a massive investment portfolio that in some ways is actually more impressive than Ares Capital. Owl Rock's portfolio consists of 93% senior secured investments compared to 77% for Ares. Again, senior secured are considered safer than unsecured or equity investments, as they would receive their money first just in case the companies the BDC invests in were to go bankrupt. They're pretty well diversified among a lot of different industries, much like Ares is. Other makes up 38% of their portfolio, which consists of 19 different industries in total, but you can see that internet software and services makes up the largest sector of their portfolio, approximately 11%, followed by insurance, food and beverage, healthcare, and distribution. If you remember, software and services was also Ares' largest sector, but for Ares it made up 20% of their portfolio. So in terms of portfolio diversification, I'm actually liking Owl Rock a little over Ares. Right now their stock offers an 8.59% dividend yield, and it pays a quarterly dividend of 31 cents per share. They've never increased their dividend, but again, they've only been publicly listed since 2019. But one interesting thing about Owl Rock is they have a history of issuing a lot of special dividends. As you can see in their investor presentation, their special dividends range anywhere from an additional 2 cents to 8 cents. Special dividends are usually unpredictable, and you can see that they haven't paid any special dividends since the fourth quarter of 2020. Owl Rock also claims to be very interested in pursuing an ESG investment strategy if that happens to be something you're interested in, meaning they prefer to invest in businesses that are considerate of the environment, social issues, and governance and corporate accountability. They claim by doing this it helps fulfill their goal of pursuing a disciplined, risk-averse investing strategy. But ultimately, Owl Rock doesn't have much of a track record yet, but I do really like the direction this company is heading in. Ares is still my favorite BDC, but based upon what I've seen, I think there's plenty of good reasons to keep an eye on Owl Rock. Their revenue has continued to grow year over year since being founded, and they're forecasted to keep growing into the future. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below, and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.